Hello, we are Gabriela, Isabela, Sofia, Ana, and Maria Camila, and today we're going to present a short summary of our CESIM Global Challenge Inform. First, we're going to do a case summary, then we're going to explain the strategic priorities. After that, we're going to show the decisions we made for each of the rounds, then the results, and finally, the key learnings of this exercise.
Okay, we were working with Ball Automotive Incorporated. They were facing a pivotal moment since the global automotive industry was going through a major shift toward clean technologies. The company was basically adapting swiftly to stay competitive across international markets. The current focus of the company was the internal combustion vehicles. The industry shift was that they were facing regulatory pressure. They were trying to adapt themselves to the customer preferences that were changing through the time, and that they were trying to change their technology to a clean technology. The key challenge for the corporation was that they had to restructure the operations to meet regional demands. We were working in three regions. The main opportunity was that they had that strong financial position to invest in research and development, brand growth, and also in sustainability. But we had also some risk because they had the high staff turnover and they had also a potential market share loss without rapid tech transformation. The strategic priorities for the corporation were the following. First of all, we were trying to get a regionalized technological transition to adapt to the customer preferences and the clean technology. Then we were trying to optimize production and logistics. We also tried to tailor value proposition to each market, and we were looking forward to boost competitiveness and sustainability in the market. Okay, so the decisions in the first round were the following. We were able to identify that we had an increased production, but we were not matching the demand. We had a 3,000 unit excess inventory, which created higher costs and also a low capital efficiency. When talking on marketing, we had a lower marketing investment, so we only invest the 15% of the market share. So we were not able to create like a big brand growth. We had poor brand recognition. Also, we maintained low debt, so we were actually not looking forward to get higher or grower opportunities. Also, we had no investment at all in social responsibility, so we were not able to like improve our reputation. And also, we were not focusing on human resources or research development, so we were lacked in terms of innovation and also product differentiation. Okay, so the decisions of the second round were the following. First of all, we maintained again on the combustion on the hybrids. So we had no investment on electric or hydrogen technology. We had some lack of innovation and also product differentiation as we were in the first round. Also, when talking about the prices, um, we complicated a little bit since it was kind of hard for us to enter to the global competitiveness since we had prices that vary greatly across the regions, and we also had a lack of aligned pricing strategy, so we had like a limited market penetration. Even though we had a positive EBITDA on this round, we had a 10%. We still had a poor shareholder return. We had a negative 100%. And also talking about return on equity, we had a low value on this. We had a negative 323%. Also talking about return on capital employed, we had 1.25%. So it was just demonstrating that we had some inefficient capital use. Also, according to the value that we got on the EPS, we got some signals that we had some ongoing losses. As we were in the first round, our reputation was not really good. We had kind of a poor score on this. We had a 2.61. Since we had a low social score, we had the 1.8. I will say that a moderate score for environmental efforts, the 3.65, and kind of lower the governance score. So still, we were not investing on this area of the company to improve our reputation. So what we need to focus during this next rounds was that we needed to align the pricing for regional competitiveness. We had to improve the financial management for better results according to the different indicators that we had, and also that we need to focus our company in the social responsibility and governance so that we can improve the reputation of the company.
Now I'm going to talk about the decisions of the third round. So, due to all of the context and all of the information that the program gave to us for this round, we estimate that the demand was going to increase by a 15%. This was like 2 or 3 percentage points over the estimate demands that we made for the last round. This helped us to produce more products and so we can assist or attend all of the demand. Then we shows that we wanted to maintain the same market share assigned to all of the technologies in all of the countries. We thought this was going to be okay because we wanted to improve a little bit the fuel industry, but then we realized that people wasn't that interested in fuel. They were more interested in new technologies like hybrid or electrics, and that was something that we had to improve, the hybrid and not so the fuel. So that was a little mistake we made. Then we didn't make an investment in the electrical technology because we read in the context that it was the providers of this kind of batteries were having a lot of demand, so they weren't having the time to produce all of what they have to sell, so they were increasing the prices in the battery, so we didn't want it to have more costs. Then we make a reduction of productional spending. We made the reduction because the consumers weren't that interested in marketing campaigns and all of those things. They were more interested in the product indeed and not in how we sell it. They wanted to see the quality and all of the characteristics of the product, of the technology, but not like huge marketing campaign. So we that helped us to reduce a little bit of the cost. We were having a lot of costs, and so that helped us a lot. Then we reduced the long term debt because we were having a lot of debt, more like 50 million of dollars, and that wasn't being helpful for us. We were depending a lot on that in that debt, so we wanted to reduce it by 5%. And we didn't borrow any domestically money inside of the company, inside of the countries, because that we didn't thought that was necessary. And finally, we keep the same salaries and we train the employees better. We maintain the value of the training because we wanted to have prepared um, employees and a prepared personnel. So that helped us to have a better efficiency than the rest of the market. The rest of the market were having 1.06 and we had 1.22. That was really good for us. Well, as a summary, all of these decisions were partly right because they helped us to open our minds to what we were doing wrong in the last round, but some of them increased the costs. Like we also increased the exports from China to Europe, and because of something that of the Sosa channel, it was closed, so the costs were so high. So due to we improve or increase the exports, the costs were so high that we lost a lot of money in this round, and also we didn't take into account a lot the the investors, and that was a little bad because the main purpose of having an enterprise is making money for the investors, and we didn't have that much of money for the investors. We had loss in that specific field.
In round four, our team decided to maintain the same strategy as in round three. This was a defensive move aimed at stabilizing operation after a series of poor financial results.
Why we didn't change the strategy? Well, we were already in a critical financial situation with negative equity and very low shareholder return. So, changing the strategy drastically will have increased risk and require capital we didn't have. We believe that some of the decisions made in round three needed more time to show results, especially those related to hybrids, marketing, and sustainability. We continue the production of combustion and hybrid vehicles in both the US and China. We did high investment in R&D workforce. We did a strong marketing in the US for hybrid vehicles. We moderate the renewable energy use in both plants, and we did no new investment and no new technology licenses. So for the results, some of the results, we take that the shareholder return improved slightly from minus 99.87% to minus 99.30%. Overall, the strategy helped contain losses, but wasn't enough to reverse the situation. So our goal was to preserve operational stability and minimize further damage, hoping for incremental recovery. Although some indicators slightly improved, we acknowledge that bolder actions would have been needed earlier to achieve a real turnaround.
As we can see here, through the four rounds, our company faced continuous challenges and was unable to create shareholder value, with a cumulative total shareholder return dropping to minus 100% in round 2 and ending at minus 99.3% in round 4. Despite some improvement items, our EBITDA fell from 21.78% in round 1 to minus 16.88% in the final round, indicating severe inefficiencies in operations. Our earnings per share also worsened significantly from $0.42 in round 1 to minus $28.40 in round 4, reflecting the pending losses. Key financial indicators such as ROE and the net equity ratio were marked as NA in the last round, showing that our company had negative equity and was effectively insolvent. Additionally, our ESG reputation and score remained low, ending at 2.39 and 2.48, far below other teams. These results highlight a failure to align our strategies with market demands and operational sustainability. The key lesson is that successful business decisions must balance financial health, market strategy, and sustainability to create long term value.
So even though our results weren't the best ones and we definitely didn't win, the simulation still gave us a lot to learn. One of the biggest lessons was realizing that focusing only on short-term profit wasn't like the right idea or the right approach. In the early rounds, we based most of our decisions on increasing the profit number. We assumed that higher profits mean we were like doing well in the simulation, but over the time, we saw that this strategy made us overlook other like key areas like RID, employee training, sustainability, and also the brand positioning. We also learned that in real business environments, maximizing immediate profit doesn't always mean creating long term value. I think that the smartest companies find a balance between making money and also investing in future growth, innovation, and responsibility. Another key takeaway was that there's no single strategy that works for all the markets. We saw how the US, China, and Europe each require a different approach. For example, price sensitivity is higher in China while Europe values sustainability and the US responds well to strong product features and promotion. That showed us how important it is to adapt to each region and to think strategically on a global scale. We also saw from the other teams that long term investments, like in new tech, factories, or sustainable practices, may not pay off right away, but they are essential to building like a stronger position in the future.
In the end, this experience reminds us that leading up businesses isn't about like chasing numbers. It is also about understanding the impact of every decision on the company, on people, on the planet. Real successful comes when strategy, responsibility, and vision comes together. And even if the results don't show up right away, the way we choose to lead will always define the value like that we create.